Bring in Mark Williams, who's Chief Asia Economist at Capital Economics in Canada. Mark, before we talk about the news of the week, let's just talk about the recovery and why it has been so uninspiring, as they were kind of one of the last major ones in the world to pull all those COVID restrictions.
Well, I think partly many people probably expected a little bit too much. I think people were perhaps looking at what happened in Europe or what happened in North America after lockdowns and the scale of the rebounds that we saw there, and thinking we should get the same thing from China. That was never going to happen, partly because actually China's manufacturing sector in particular was never in that deeper hole to climb out of. One of the focuses of zero COVID policy last year in China was to make sure that factories kept running. So I think part of this is that people maybe had exaggerated expectations of what we should have, what we should expect. But having said that, the bit of the economy that we should have expected to have done pretty well was the services part of the economy, retail spending, restaurants, hotels, and that kind of thing. It came out of zero COVID very strongly in January and February, but in the past 2 or 3 months, it really seems like that momentum is already slipping. So in the most recent numbers, we had retail spending up just 0.3% month on month in May. Even areas like restaurant spending, where you would think people would be enjoying getting back out there, those have been very weak too. So it does feel like things are kind of petering out before they got anything like back to what we might think would be normal.
So that brings us to the interventions this week. It cuts to shorter term lending rates, but fueling expectations that we could see more when it comes to stimulus. How big of a bazooka do you expect China to bring out to try and juice that recovery?
Yeah, I don't think China's bazookas are so big anymore. I mean, the moves that we've seen this week are 10 basis point cuts to policy rates from the People's Bank. I mean, these are just signaling moves. They're not, in practice, directly going to do very much for anything. The problem the People's Bank has, though, is that even if it were to lower rates a lot more, there's a lot of evidence that nobody wants to borrow. So households don't want to borrow to buy houses because they're worried about the outlook for the property sector. Corporates are just generally concerned about the outlook for China's economy at the moment and aren't borrowing. So I don't think there's a great deal really that the People's Bank can do at this point. It really probably has to come from the finance ministry, from fiscal policy. We've not had anything on that side yet, but that's where I would expect the bigger action to come. But again, there's problems for the finance ministry. You know, in the past, you want to stimulate China's economy, you pull the big lever that says property, and you get everybody buying property, developers piling in, building more stuff. That always worked in the past, but we've moved through into a new era in China's economy where the property sector is not just going to keep on growing and growing rapidly. And so it's a lot harder for policymakers to use that channel to stimulate the economy. They'll probably be using infrastructure spending, I think, over the second half of this year. So still more pouring concrete, more investment, but I think it's going to be a lot less effective than previous rounds of stimulus that we've seen over the past 10 or 15 years in China. So we should expect something, but I don't want to get everybody's hopes up too high.
Well, and outside of, the typical economic cycles that we track for China, there's this kind of slow-moving structural shift, reshoring, friendshoring. Is that going to complicate the success that China, either on the fiscal or the monetary policy side, has in being able to stimulate the economy?
Yeah, I think what these things do is just create shadows of doubt for everybody about the long-term outlook. And that means that in the short term, people are less willing to spend and less willing to invest. I mean, China is not massively dependent on foreign investment, but the fact that foreign firms are looking elsewhere to build, Chinese firms see that as well, and that makes them a little bit worried about the future. The fact that the population is now falling means that property developers, and remember the property sector is what, sort of 20, maybe 25% of the economy, they're not going to be wanting to build as many properties as they did in the past. And anyone that is thinking, long run about China has to factor in the fact that the long run trajectory is a lot worse, and that's going to make them cautious about investing too much in the near term.
Now, China notwithstanding, there seems to be hot pockets within Asia, whether it's Korea, whether it's Japan. The markets, certainly on the equity perspective, are ripping higher, and they seem to have some cover when it comes to inflation. The inflation problem doesn't seem as acute as it is, say, in North America or even in Europe.
Yeah, that's certainly true. I mean, we've seen over the past 18 months that the inflation never rose as high at all in Asia as it did elsewhere. Asian economies didn't have such big stimulus programs as we saw in some in Europe and in North America. That's part of the explanation. There was far less supply chain disruption within Asia because the manufacturing base domestically was so much bigger. So they haven't had as big inflation problems. Central banks haven't therefore had to raise rates as sharply. And in many cases, we think that rate hikes have already come to an end. So whereas in many G7 central banks, we're thinking kind of they're raising more than maybe we had thought they would a few months ago, that isn't really the case in Asia. They can afford to keep rates where they are, and probably the next move in many cases will be down.